It's a majorly green screen across the Asian markets, barring the Hang Seng though.
23,460 is the recent low that we saw, and a break below it will confirm further downside levels.
There is no reason to believe that this is a dangerous virus or anything which we should be worried about this virus.
About 1/3% higher as far as the market open is concerned, 23,706 on the Nifty.
Overall, I think for emerging market funds, flows will be very muted till we get some clarity on the tariff picture.
Considering the seasonal weakness caused by furloughs in Q3, don't expect too much by way of growth.
Yesterday, around this time, it was at 85, 84. It's a near 20 paise recovery that we have seen.
The benchmark indices gained close to about 0.5%. The mid-caps are up nearly 1%.
A case was made for reducing GST on CNG two-wheelers.
Absolutely no moves on the bench, at least on the benchmark index, but the broader markets are having a good day.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, the day so far has turned out to be pretty decent after the initial sort of sharp sell-off. Markets have stabilized and we've been trading higher for the last few hours at least. This is Closing Bell. I'm Prashant. With me, my colleagues Reema and Surbhi here in the studios. Nigel is joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, it's a full house today.
Absolutely, but you know what? I am still keeping Nigel's fingers are like this, my fingers are like this. And that's because it's the last hour and the bulls will really hope and pray that they can go home with at least some gain and we don't get that slam dunk that has happened many a times in the last 60 minutes. So let's see.
No, absolutely. And, I'll just quickly then outline a few things before we sort of really dive into the nitty-gritties of the market. So some rebound, and it's been there from the morning. Broader markets are doing better, though. So Nifty is up 0.4. Actually, Bank Nifty is doing better than the Nifty, but the mid-cap and small-cap indices are doing better than both. 1% kind of gains on both the mid and small-cap part of the market. Only you look at the large sectors, only IT services is down. And actually, it's quite a reversal from the opening levels. IT services, the index opened about, I think, almost 0.75% higher. And the IT index is down about 0.75%. Everything else is largely up. I mean, one or two sectors are flat, but the bigger ones. And a lot of PSU in the green. Energy, defense as a sector, oil and gas. I mean, that entire pack is doing very well. Nifty, of course, the high today was nearly about 23,800, and then it found resistance, and that's basically the first kind of resistance zone. On the Nifty Bank, resistance is at 50,657. That's a 20-hourly moving average, simple moving average, which, of course, we are some distance away from, about 1% away, roughly, a little less than that, to speak of. So not a bad session, and the broader markets, of course, are doing better. Lots of single stock action. Reema.
Well, Reliance Industries is the big heavyweight contributing on the way up. It's 1.6% higher for Reliance Industries. So that's providing support. Other gainers include ONGC. We'll talk more about that. Life insurance companies, SBI Life, HDFC Life on the gainers list. Tata Motors is a winner. It was an underperformer last year. It's bounced back smartly. And green on the screen for IndusInd Bank, Hindalco, Adani Enterprises, BEL. On the way down, as we said, IT is on the back foot today. So HCL Tech, TCS, Tech Mahindra under pressure. Cuts anywhere between 1 to 2% for the large cap IT names. Eicher Motors, Hero MotoCorp. So some two-wheelers too aren't having such a great Tuesday morning. But by the way, not to forget, now the sensex weekly expiry happens from Tuesday. Remember the entire change in the changes which took place. So it's effective from today. The sensex weekly expiry will be on Tuesdays.
Okay, all right. So we'll watch out for that. On the mid-cap side, it's a pretty vibrant market and lots of individual stocks moving around. Lots of news, actually, and stocks reacting to brokerage notes as well. I'll just give some examples. Biocon is one. There's a Jefferies note that's worked well for the stock. Plus, they've got a approval for a biosimilar drug in Japan. There's AkzoNobel, which has now made it official that, yes, they are indeed looking to put the decorative paints business in India on the block. So the market knew this, I mean, and we've spoken, a lot of companies have shown some sort of interest, but the stock's still reacting to it today. Some of the pathology plays are interesting. In the morning, stocks like Dr. Lal Path Labs was slightly lower, but now there is a bit of an upward drift in this one, about 3% higher. Metropolis also started negative in the morning, but since then these stocks have sort of recovered. So, diagnostics is an interesting space. And then you have something like, of course, Zomato, and you'll hear more about it. Why is Jefferies so concerned about Zomato? Why have they cut their target price by almost 18%? That's what's led to this down move today. So we'll talk a lot more about these individual stocks as we go along. But Nigel, I guess so far so good?
Well, that's right. You know, the bigger point today is not the 100-point gain you're seeing on the Nifty. The bigger point is that the advance decline ratio is 4:1 in favor of the number of stocks that are advancing. Yesterday, it was inverse. It was 10 stocks that were declining for just one stock that was advancing. So the breadth of the market is looking quite good. The Nifty is up close to under 100 points. And the mid-caps are outperforming today after the kind of, hammering that they got yesterday. So for the time being, at least things are looking up. Yesterday's fall didn't come on very, very large volumes. Today, the volumes are pretty much okay. So we're hoping that we do see a positive close by the time we wound up. Mitesh Thakkar is back with us. Mitesh, bounces were likely to be shorting opportunities. The Nifty is currently at around 23,200, which is 200 points away from the 200 DMA. What's your reading? Do you still see weakness? Do you still believe that a pullback is on the cards? And would you be looking at this bounce to short it?
So I think we kind of held on to our option spreads. You know, the idea is that there was a bounce back. We saw the Bank Nifty go up to as high as about 50,447, and 5,500, 600 is my zone, where I think the Bank Nifty will face a lot of resistance. And it didn't even attempt that. So I think we'll maintain that. It might be that, given the fact that we had a very strong fall last day, it could be, a counter move, bounce kind of a move to it, and it might try and hit the resistance levels. But as long as we are not crossing 50,500, I don't see any reason to cut the spread positions on the option side, because we still have a long way to go to the expiry, and there's still a chance that we might retest or even break the lows on the Bank Nifty, which is 49,800, 700 zone. And if that happens, that will pull the Nifty as well. So I think maintaining a mild short bias still, we don't see a cross on the upside is the way to trade, or is the way to go forward for me. The idea is that I've taken option spreads because yesterday we had a big fall. In case you get closer to 5,500, 550 and then see failure from there, I think then you might even want to look at future shorting positions. So it's just tactically positioning myself. But yeah, the possibility is that there is a stronger chance of us breaking down unless until we get past 5,600 on the Bank Nifty. And on the Nifty as well, the levels are slightly higher. It's about 23,900, 925. So as of now, I'm focusing only on the Bank Nifty.
And stocks, Mitesh?
On the stock side, HPCL is a sell for me. Keep a stop at about 394. Look for a target of roughly around 370. And I'm closely watching ICICI GI. That's on the buy side. Recommend a buy here with a stop at about 1842 for targets of 1950.
Thank you. Let's talk about Zomato and ONGC. These are the big movers on the way down and on the way up. Hormis joins in with more.
Zomato, after the downgrade that has come in from Jefferies, that is seeing a bit of pressure in today's trading session. They downgraded the stock to a hold, and from an earlier rating of buy, it's also cut its price target to 275 from 335 rupees earlier. And it is this quick commerce opportunity that was once supposed to be the growth horse for these companies like Zomato and Swiggy. That is now turning out to be a concern for Jefferies, considering the rising competition in the space, be it the likes of Zepto or even the foray of Amazon into this quick commerce business. Now, what Jefferies is also saying is that 2025 may be a consolidation year for the stock of Zomato, simply because of the run-up that it saw in 2024 when it more than doubled in value. And it has downgraded Blinkit's EBITDA estimate sharply for FY26 and 27 and has halved its target multiple to 6 times. What it has also done is the fact that for Zomato overall, it has cut its EBITDA estimates by 12% and 15% for FY26 and 27. The profit estimates have been cut by 17 and 18%, and the EPS estimates have been cut by 20 and 21% over a 2-year period. So Jefferies, a first downgrade coming in for Zomato after a very long time, and one of the few analysts who have issued a downgrade on the stock, and it's showing up in the price as well.
Thank you very much for that. HSBC is also written on quick commerce, and they say investor exuberance around quick commerce outlook is high. They think the total addressable market is much smaller for this industry than broadly understood. While it may not matter in the near term because growth rates will still be solid, but worries may start to emerge in 2 to 3 years. They still like Zomato. They've got a buy rating. This is HSBC, but Swiggy is a hold for them. Deepak Shenoy, founder of Capital Mind, is now with us on the show. Deepak, weigh in on Zomato after the kind of run-up that we've seen. Is caution warranted?
Thanks, Shiva. I think the complex nature of, say, Zomato business, which is both food delivery and instant commerce, the rise that has come in because of Blinkit and its success, relative success recently, I think there is a certain issue with it, in my view, with respect to a relatively high loaded inventory cost for such a model, which will be more back-ended. And I think I've talked about it earlier, and we were an investor, but no longer are, because the inventory costs currently don't appear in the system because a lot of it goes to the dark stores. But eventually, dark store ownership will have to be done, or the whole dark store ownership has to be by Zomato directly. They'll have to eventually procure ownership of those dark stores and run them by themselves, because nobody else is going to take the deep inventory losses that generally exist in retail business, which currently does not show up on Blinkit's balance sheet. So my feeling is that may be something that will come in the next year or 2 years and will become apparent to us. I don't think there's going to be a massive slowdown in terms of business itself. I think people do get used to being able to get something in 10 minutes. But if you load inventory costs and then make a profit, you'll have such high delivery costs that the business will break down by itself. So I find that this model is a little unsustainable today. But with technology and certain innovations, maybe you can make it work. I just don't see that yet happening in any of the Indian players, at least.
I remember asking Sri Harsha Majeti, the founder of Swiggy, just when they were listing, exactly this, that this handling fee and the platform fee that they charge, it ranges anywhere between 6 rupees to about 10 rupees per order, whether that will still last if the likes of Amazon come into the picture in quick commerce. Well, they maintained a brave face, but it seems the street is also taking some of those concerns on board right now. All right, just stay on, Deepak. By the way, Happy New Year to you. More questions coming your way in just a bit. That's the first stock that we're looking at, which is reacting to a brokerage note. The other one is ONGC. And ONGC is reacting on the upside. It's the best performing stock on the Nifty for the better part of the day today. And that's thanks to CLSA sounding very, very optimistic on the prospects ahead. Back to Hormaz. Hormaz, what's the story here?
Well, ONGC is not among those PSUs who we used to name who are running up away at a breakneck speed, but CLSA now has a very high conviction on the stock, and that is why it has upgraded it to a high conviction outperform. A price target of 360 rupees, a potential upside of anywhere between 40 to 42% from yesterday's closing levels. What it says is that this Eastern offshore, once it ramps up production to peak capacity, that will increase ONGC's domestic oil and gas output anywhere between 10 to 20% by the end of this year. And the removal of the windfall tax is another positive for them. That will help them earn more realizations than what they are earning right now, provided the crude oil prices continue to recover, which they already are for over the last week or so. And despite multiple triggers going in their favor, ONGC is trading at a valuation that is at a significant discount, not only to its own historic multiple, but also to the historical multiple of its peers as well. And along with this, it is offering a very healthy dividend yield of around 6%. So ONGC has now become a high conviction stock for CLSA. The upgrade coming in there, a price target implying another 100 rupees upside from the current levels, and it's showing up on the price as well among the top gainers on the Nifty.
All right, Hormaz, thanks very much for getting us the updates on both of those stocks today. Back to Deepak then. Deepak, yes, so going back on the other stock, ONGC, I don't know if it's a high conviction idea for you or not, but no arguing on that dividend yield point, right? That always looks very, very lucrative and sweet to investors.
No, it does. Firstly, Happy New Year and thanks, and wish all of you at CNBC-TV18 and of course all your viewers as well. ONGC was about roughly the same price 10 years ago. So yes, we've heard this before. They have had fantastic valuations. They were at low, cheap valuations 14 years ago at I think 12 times earnings. Now they're at 8 times earnings. The price hasn't changed too much. The price of crude possibly hasn't changed too much either. We've not seen ONGC make any reasonable moves. Of course, they had to buy HPCL in the middle from the government. So they are now effectively also a downstream player, not just somebody who manufactures crude, but also benefits from the retailing. But there's not that much that seems to have come in from the operation leverage that you've seen the last 10 years. So yeah, I mean, I would say maybe you would use some technicals or a short-term momentum to play this stock, but it seems fraught with danger to play it from a more fundamental angle in the long term. If it makes too much money, the government is likely to use its coffers to buy something else that the government wants to sell. So, not very really interested here. And with all that money, they should be investing in something that is more in the renewable spaces, maybe electric or something like that, that allows it to benefit from a move out of the traditional oil and gas space. But I don't think they do that at all. So I think, good for a short-term play, perhaps. I don't think I have any conviction in this longer term.
Okay, all right, got that. Hi Deepak, good to see you again, and Happy New Year to you. Since you didn't go to Goa, I said I'll do your bit. I went to Goa for Christmas to the New Year's break, but I believe you go there thrice a year. So lucky you. It was pretty okay, but this time I think you went overseas. So look forward to catching up with you sometime during this year. Well, Deepak, I wanted your view on the paint space actually. And my colleague Rachna is picking up some exclusive details with regard to the AkzoNobel deal. Rachna, fill us in with more details. What are you picking up? Who are the potential suitors?
The battle for AkzoNobel's India stake is heating up. Berger Paints is likely to join the race to acquire AkzoNobel's 74.6% stake as the global parent explores an exit from the Indian market. Sources have told CNBC-TV18 that the competition is between Berger, JSW and Indigo Paints, and the value of this deal is expected to be in the range of 10,000 to 12,000 crore rupees. Now, AkzoNobel's India market cap currently stands at around 16,000 crore rupees, while its revenue for the September quarter was reported at 982 crore rupees. Let's compare that to Berger Paints' performance, where the revenue was at 2,775 crore rupees in the same period. As the contours of the deal, whether cash or a hybrid structure, continue to take shape, CNBC-TV18 is awaiting official responses from AkzoNobel, Berger Paints and other companies involved. But we had the Berger management on the channel on November 6th, where they had said that though they usually look at smaller acquisitions, there is an interest in AkzoNobel's India stake, and now we have it from our sources that the bids are being submitted for this acquisition. Back to you.
We'll have to keep an eye out on that one, but post that exclusive story from Rachna, we did see that the stocks got quite excited. Deepak, what are you making of this? First you had a tussle because of new players coming in there. Now we're going to see potentially some consolidation. Your view and your pick from the paint industry?
Nigel, firstly, Happy New Year to you too. Thanks so much. But the story of AkzoNobel has been going around for quite a while, saying, why are they here? They're like number 4 and perhaps now number 6, since about 2 or 3 other players have started to get into the space aggressively. But they are one of the most well-respected and perhaps the best technical paint company in India. In terms of the quality of the paints is probably the best. They just don't have the distribution clout that Berger and Asian have. And perhaps some of the reasons why the other players are interested, and I don't think it will be limited to the 3 that you've talked about. It may involve some of the other players also coming in who may want a foothold into this space or take whatever space the higher end brand of, say, Akzo commands in this marketplace using the distribution clout that the bigger players have. I think you're going to see, if you're going to see a battle for this, the price will be even higher than this. It's about a 38 times earnings right now, less than what some of the other players are valued at. So technically, if Berger bought them, you would actually see an improvement in Berger's or a better PE ratio for Berger because it's valued at a little bit higher. So in that context, though, I think the space does need consolidation of some of the older players. because there are at least three new players that have come in. So it's going to be a battle, and I don't think Axo ever wanted to be in the price war a space at all in the paints industry. And now I think it makes more sense for them to exit, because you're getting a decent price in a place where the battleground is going to involve much lower margins for everybody involved. So I think it's a good outcome for Axo if they were to exit, and it will be a good entry for some of the newer players who will be able to use whatever name Axo has to be able to further their progress in the space. So I don't really think it will be great for the shareholders of any of the paint companies in India, other than maybe Axo shareholders, if there's a bidding war on it.
Okay, so that's on the paint space. Lots of excitement there on the possibility of what happens with a part of Axo's business here in India. Actually, speaking of who was going where in the last couple of weeks, I just want to tell you, Deepak, that I was in your city for a day or two. Always been a massive Bengaluru fans. Great food, great coffee. So yes, missed seeing you there, but nonetheless, awesome as always. Let me ask you about a Bengaluru-based company now. That's the next stock, which is Biocon. Today, it's moving up on some news, and again, there's a positive brokerage note around it. 7-8% higher. But how do you rate the business as of now, and what views?
Surabhi, I probably sound bad for saying this, but I haven't tracked Biocon for a while.
Okay.
Even though it's like, in our part of the woods, but, it probably takes me as much time to get to a Biocon than it does to get to Bombay. So I'm sorry, I don't have too much to comment.
Okay, no worries. We'll let that one go. Let me ask you in general about healthcare. But healthcare and, pharma, they've been the best performing stocks in the market in 2024. And if someone is to keep continuing with a little bit of conservative stance in the portfolio, what would you pick? Pharma, healthcare, hospitals, diagnostics? Any ideas here?
Yeah, we're actually positive on hospitals. So we have this, we have the thing that India actually has a lot more potential for hospitals, private hospitals per se, because in India, healthcare is relatively cheap compared to most of the world. And even, of course, it differs on type of treatment, but there is a significant scope and significant range of services that are provided by hospitals in India, which allow them to be reasonably profitable as well in the long term. Unfortunately, I think there have been ups and downs in the hospital industry from at some level, say bad governance in certain companies and so on. But I think within the hospital space now you have some really good players. And again, we own a player that's a Bangalore player here, Narayana Hridayalaya, which is a relatively smaller player than the rest. But we think there's a lot of scope for it to grow substantially, and they have a very clean image. And also serve more of the mass part of the population rather than being more exclusive. So I think that has a lot of potential. Diagnostics, I'm not so sure, because none of the diagnostic players seem to be warming up to some of the new devices that are being invented abroad. Whether it is Abbott inventing something that is a subcutaneous constant glucose monitoring device. There's nothing of that sort that's being used by any of the diagnostic centers or integrated by the diagnostic centers to set up more of the business on what are individually or personally owned devices, where I think the future is. And I feel that will cut into their business eventually. If people are able to get A, B, C done today, tomorrow it will be D, E, F as well, which are what you go to diagnostic centers for. Pharma, I'm not very deeply informed, but I think there's some value plays there even now, because there is a significant part of drug portfolio that's coming off patent in the next few years, based on what happens after January 20th. The tariffs and Trump and all of that, you might see some opportunities open up for the Indian pharma manufacturers, API exporters, even drugs exporters, based on what happens. So I think right now I'll hold my thoughts on it until we find out what's going to happen with this whole new change of president in the US. That's where the biggest export market is. But when that happens, you might actually see some opportunities open up for India in that space. But some of the things will not exist. Some of the earlier thoughts will not exist.
Okay, all right, Deepak. Thanks very much for that view on pharma and healthcare. So Narayana Hridayalaya is one of Deepak's picks in that space. Thanks for joining in. Good talking to you as always. Well, time now to introduce the Growth Code, a special initiative by Grow and CNBC-TV18 to further empower retail investors and traders. Renowned investors and professional traders convened at Grow's Trading Right event on the 9th of November, where they shared valuable strategies. Here's a snippet of what pro trader Rakesh Pujara, managing partner, Compounding Wealth Advisors, had to share about the reality of trading scams in the market.
अभी जो स्कैम हो रहे हैं वो क्या प्रकार के हो रहे हैं कि लाइक सपोज आई एम एन पॉपुलर फिगर इन सोशल मीडिया सो my parody account will be formed and people will be invited to join some course or transfer some amount so that they can trade. Even false demat statement have been shown under the name of some well-known international company. Your holding is shown there, actually your holding is not there. You are being promised कि जो सर्किट होगा, जहाँ पर सर्किट है जो स्टॉक्स में, वो ये प्लेटफॉर्म पे नहीं मिलेगा, लेकिन हमारे प्लेटफॉर्म पे आप डालोगे तो आपको शेयर्स मिल जाएंगे. एंड एक्चुअली दे हैव शोन कि वो शेयर्स मिले हैं, डिमेट अकाउंट में उनको दिखाया है, एंड अल्टीमेटली इट टर्न आउट टू एवरीथिंग वाज काइंड ऑफ डॉक्टर्ड. तो ऐसे स्कैम काफ़ी हो रहे हैं. जो काफ़ी पॉपुलर लोग हैं उनके नाम का प्लेगराइज अकाउंट बना के कोर्सेज बेचना या फॉल्स प्रॉमिसेस करना.
Okay, welcome back. 90 points higher, and 23,700 is where we are trading at right now. Aditya Sood of InTrade Asset Management is with us. He's our Alpha Manager of the day. Aditya, good to have you back on the program. I think speaking with you for the first time in the new year, so wishing you the best. In your multi-cap portfolio, Aditya, so many pharma/hospital names. Some we've spoken about, like Indraprastha Medical. But I think you own names like Healthcare Global, etc. as well. We were just having that chat with Deepak Shenoy earlier in the previous segment. And he's a big sort of votary of that. And why not, right? I mean, health is, of course, expenses towards health at a very basic level perhaps is the biggest unknown. And spending towards that is increasing. So almost as a form of health insurance, some of these hospital stocks and the returns that they might generate. Just your thoughts here, on the healthcare space from a hospital point of view, Aditya.
Sure. Very happy New Year to all your viewers and the team at CNBC. I think so broadly, the construct that we are getting into for the broader market is that, the earnings growth is slowing down rapidly. So if you do a top down of, which are the sectors which are going to be fairly resilient in this phase, possibly, pharma is one of them. From a hospital standpoint, I think so. One of the things that we like about the sector is that, it is about affordable healthcare globally, from a hospital standpoint. Secondly, it is also about access to healthcare. So when I speak to my relatives or I speak to my friends who are visiting India and who live abroad, the stories that we hear is that, you don't get access to an oncologist for like 45 days in the US possibly. So people want to just fly down and get themselves, checked up. I have spent, 6 years of my life in UK, and we all know, what kind of shambles NHS is in. So essentially, I think so. If you go and see today, hospitals, particularly based out of NCR, there are certain hospitals which are having, as high as 25 to 30% of their revenue coming from medical tourism. I think so. It is a fast evolving theme. Secondly, obviously, it is a well-known fact that India is much more affordable than, all of the other places. Thirdly, I think so there is a change in psyche generally, post-COVID. And when we speak to, hospitals in general, what we are given to understand is that, you look at the sector pre-COVID and post-COVID, what you have seen, for example, in the case of Max, being an example, 8% margins have moved to 30%, sort of EBITDA margins. The same has happened to, Indraprastha, which we hold, margins were stuck in that 10-12% range for like 10 years. And now possibly, margins are trending more towards, 16 to 18%. So that is one element of, margin improvement. Secondly, I think so there is also a lever of marginal occupancy improvement, which is happening now. And we have, more, sort of capital allocation getting better for certain names, in the sense that people don't want to get into that capex mode. So there are a lot of acquisition which is happening in the sector. For example, we have seen acquisition by Yatharth. We have seen, JP hospitals getting acquired. And we are also seeing a lot of private equity deals, in this space. So that leads us to believe that, there is a lot of margin potential and ROC rating in the sector, which we are going to witness going forward.
Aditya, what else? What are the new ideas for wealth creation? Where is it that you see opportunity now? In the last 1 or 2 months, have you made any new, have you spotted any new ideas?
So our focus is very clear. I think so broadly we are in middle of a turmoil. That turmoil needs to, needs to be understood from a perspective of, what is happening in global bond markets. What we are seeing in the currency market also, in the sense that the euro dollar is, more or less closer to parity. Now, this all will create an opportunity, because what we have seen is that, there are a lot of companies which have corrected very, very sharply, and a lot of large cap names are down by, 20-30%. So there are only two kind of stocks that we like at this juncture. We like companies wherein the sector is going through a headwind, at this juncture. But that headwind has resulted into a gap of price to value perception. And obviously MFI is one such sector, which is facing that headwind. It is most of the MFI stocks have corrected from 50% to 70%. Now our framework says that, possibly we'll buy the best managed MFI company, which in our view is Credit Access Grameen today. But what we are resorting to is that, we won't buy the full weight, because we do understand that, possibly there could be 1 or 2 quarters of pain which can come through. But we are buying these stocks from a 18 to 24 month perspective. Possibly we believe that, from a 2 to 3 year perspective, these stocks can double. So that is a huge focus area for us. Second focus area is to buy, companies wherein we have already seen a correction of 30-40% quality stocks in the portfolio, and we would like to add some weights. For example, Tejas is a case in point wherein 1550 stock price has corrected very sharply to 1140. Nothing has changed in the fundamentals. In fact, the fundamentals are now getting strengthened. So our view is that we will stick to the core, and we will buy companies wherein we see opportunity. Or else another opportunity that we are seeing is in special situations. So we have recently added a company known as Religare Enterprises. Obviously, there is an impending open offer, which is there, that this is a corporate change event. And obviously, it is closely linked to the way Care Health is, sort of trading in the unlisted market. We believe that the discount is very, very stark. Basically, Care Health is trading at a 16 to 18,000 crore valuation. I think so it is easily one of the better managed health insurance plays in the country, after possibly, ICICI Lombard. I would rate, Care Health very, very highly, given the fact that they have grown the gross underwritten premium at 32% CAGR for last 5 years. They are very, the combined ratio is close to, 101.5. That leads me to believe it is part owned by Kedara Capital. That leads me to believe that there has to be a value unlocking event over a period of time. And obviously, if you do sum of parts of Religare, you will see that there is a broking business, and there is a lot of optionality in the sense that if the management control is with the Dabur family, obviously, you can expect the NBFC over a period of time to get levered over. So we find special opportunities to be a very, very interesting case in point at this juncture.
Okay, all right. Hi, Aditya. Good afternoon. Good to see you, Ben. You gave us many stocks actually in 2024, and a lot of them did well. And as you're saying, you're backing yourself still on Tejas Networks. I was going to ask you when it's time to get off the bus, but you believe that it's time to just add on that one. So clearly you have a fair bit of conviction. But let's talk about a couple of larger names then. HDFC Bank, case in point. We briefly discussed that, I think, somewhere in the middle of 2024. What's the view on the stock? The last quarter's operational performance wasn't very, very great, but there were pockets that actually they're correcting themselves. Also, valuation-wise, in comparison to what it trades at, it's not very, very expensive. Similar is the case with the Bajaj Finance twins, FinServ as well as Finance. They have started 2025 in style. Your view on particularly these two names, Finance, FinServ as HDFC?
So, essentially, our view on some of these great companies, and we have focused on a framework wherein we say that possibly all the great companies can make zero return for 3-5 years. It is very normal in the stock market. And there are two ways to make money in a stock. Put it very simply, we don't see any further room of price to book, deterioration in possibly a Bajaj or a HDFC Bank today. I would say that, I would back these companies that, possibly if I'm buying HDFC Bank at, 2.2 time price to book, and if I do the sum of the parts, and obviously, a lot of value gets also derived from the subsidiaries that they have, especially in the case of, Bajaj Finserv as well. So we own Bajaj Finserv, we own HDFC Bank as well. So our view is that there is very limited room to lose money. Now, where can you go wrong? Possibly you can go wrong in terms of, the earnings growth that gets delivered. But our extension of the thesis also is that great companies are great because they can bounce back, and when the environment is tough, possibly, we are more focused towards whether they are gaining market share at this juncture. So I think so. Each of these names have got, different challenges. But our view is that, they have, whether they have lost market share in a down cycle, possibly they have not lost market share in a down cycle. Again, on financials, one thing is very, very clear that it is the ability to manage NPAs across the cycle well, rather than chasing, fast growth. So, more often than not, we keep on hearing that, HDFC possibly as a case in point would have, as I'm given to understand, has, stopped lending too much to the solar companies. So this is a business wherein you need to have an ability to go fast and slow. And this is a business wherein you need to focus on medium term and not short term. So that is how I would like to put it across. We see significant value accretion over a period of time. These are large cap names, so your expectation of return has to be moderated here. I think so 15 to 20% CAGR, possibly over a period of time wherein 5-year return has been zero, should be the right kind of expectation from these names.
Thank you very much, Aditya, for joining in, and wish you and everyone at InCred a very happy new year. A quick word on IT and Tata Elxsi, where there was some news. Tata Elxsi, remember, has been one of the biggest underperformers of last year. Last year, the stock was down 25%. Its 52-week high was 9,080. Its all-time high level was 10,760. So from those levels, the stock has fallen close to about 30-40%. And still, despite that, it's trading at about 40-45 times forward PE. So one of the reasons for the derating was very high valuations, rich premium valuations, and two, growth was slowing down. But on to IT, because IT will kickstart the earnings season. Just want to quickly put on board what brokerages are saying going into the earnings season. So Morgan Stanley says that unlike the start of 2024, where the sector positioning was light, investors are now overweight IT. And therefore, for IT to outperform from here on, you will require significant positive earnings revision, beat on revenues, which appear less likely in the current macro. And therefore, if stocks show an outperformance in Q1, their approach will be to book profits. They like LTI Mindtree, Infi, TCS, and Coforge in the mid-cap space. But Jefferies has another view. They're saying that the growth outlook for IT is improving, and therefore premium valuations will sustain. Also, they're saying that look at IT in context with the rest of the domestic economy, where we are seeing earnings downgrades. So relative to the rest of the economy, where there are earnings downgrades, if IT continues to show you growth, then it will support the premium valuation. So that's the call coming through on Jefferies. And their top picks include Infosys, TCS, LTI Mindtree, Coforge, Agility, Emphasis in the mid-cap space. We will slip into a very short break. On the other side, we'll get you a check on what dealing rooms are saying in our segment T Street Chatter. Stay tuned.
Welcome back. Keep an eye out on a couple of stocks. You have Genesis International. The stock is now a 1,000 rupee stock. It's up close to around 10% as we speak. I recall there was a large trade that took place at around the 750 rupee odd mark. That one's moving, and it's moving on rather large volumes in today's session. So keep an eye out on that one. The other one is Welspun Corp. You know, the stock has come off the low point of the day. It was at a fresh 52-week high. Remember, ahead of Trump taking on the presidency in the United States, that could be a potential beneficiary, pipe maker in the United States. So keep an eye out on that one as well. But it's a good time to get Nimesh back on D-Street Chatter. Well, Nimesh, it's been a while since, we have been in this format. It's been a very, very long time. And at least it's a green day. First time that we are in this format in 2025. What are you picking up?
Nigel, a decent recovery, so to speak, after what we saw was a brutal sell-off yesterday. I spoke to a lot of participants on the feedback on what happened, technically what happened yesterday. To me, the sense is it was more of technical in nature, because of which the mid-cap index collapsed almost 3%. And there's literally a carnage, so to speak, in the broader market names. A bit of recovery in today's market in the broader market stocks, but the FI selling continues. So, while not large, but even today I understand there will be net sell. But having said that, there is a small MOC basket buying in some PSU names as well. So that will have a bit of an impact as far as flows are concerned. But still there, net sell is what I understand. As I said, the breadth is positive. Mid cap, small cap, micro cap, all the three indices are up between 1 to 2%. So a decent recovery from what we saw, a brutal sell-off yesterday. I guess from a sector point of view, it's the PSUs where there's a bit of traction again, and selective buying as well. As I said, in that MOC basket, there are a few PSU names as well where there is buying interest. So index is up close to 1%, the CPS index, and there is a bit of buying traction as well. But broadly, it looks like, from here on, the big trigger would be the earnings season and the fact that what happens to the fresh India allocations in the global context. So that's something to track going forward. But I guess yesterday's sell-off was more technical than the real selling from the larger FIs and institutions.
Well, that's good, right? Because otherwise you were wondering whether or not you're going to see a very large FI net sell number. That wasn't the case. Right. But tell us, Nimesh, individual stocks, what are you picking up?
So in terms of individual names, the first stock on my list is Max Healthcare. That's been buzzing in trade, large volumes as well. I guess for the last couple of days, some large FI investors have been aggressive buyers in Max Healthcare, and that's the reason why that stock is buzzing off late. The second stock is Birlasoft. Well, the stock is recovered in today's market, but there is selling pressure in Birlasoft for the second day running. So expect high delivery volumes, but there is selling happening in that particular name at higher levels. Similarly is the case with the other two names, Manappuram Finance as well as NCC. Well, both are gaining in trade today, but there is selling pressure is what I understand from larger FIs. So expect delivery volumes on the higher side. And again, there has been selling from larger FIs in both these names. And the last name is Polycab. The stock has seen a sharp recovery in today's trade. We saw a very sharp sell-off as well yesterday, and it's virtually recovered all of those yesterday's losses. There is buying interest from larger FIs, what I understand. And also there was a Jefferies note, and they have raised the target price on Polycab to almost 9,200, and they believe that Q3 could be quite strong for Polycab. So that's the reason why that stock is recovered and buzzing in trade today.
Okay, all right. Got that. Thanks, Nimesh, for all the action there on individual stocks and the general buzz that you're picking up from the dealing rooms today. Let's move on now. We've got Mitesh joining us back in. So let's get some final trades and ideas going. Mitesh, so it's been an okay day. At least the bulls have managed a bit of green. What would you work with? Last trades and, of course, a final view on the indices as well.
So two things will be. One, JK Cement is making a new high. Disclaimer, we have recommended it to our clients, so there's vested interest, but that's looking like a good BTSC trade. Keep a stop below 4,800. Look for targets of 48.70, 75 for tomorrow. And Kalyan Jewellers could be slightly negative. I think the stock is down about 3% today. The pattern is turning slightly weak. So Kalyan Jewellers is a STVT with a stop at 731 for targets of 710. And on the indices, I maintain that view. I think, the Bank Nifty, unless until it crosses 50,500, 600 zone, I think I will be inclined to take a negative or maintain a negative view. We have some put spreads, and around 50,500 plus levels might explore some shorting futures as well.
Okay, all right. Mitesh, thank you very much for that. So those are trades coming up as well. Now, the Ministry of Statistics, Government of India, will be announcing the first advanced estimate of GDP for the current year at 4 o'clock today. Eagerly awaited, and of course will be keenly analyzed. The next year's budget numbers will be based on this particular data, and we've done a poll of economists on what to expect from these numbers, and the numbers themselves. So Lata is here with that. Lata, over to you.
Well, first up, we need to know that this is the first step of the budget. What the MOSPI announces, the Ministry of Statistics and program implementation announces today at 4 p.m. They're going to announce the first advance estimate of GDP of the current year. Until now, they were only announced the actual GDP up until the second quarter. Now, this is an advance estimate. Now, the point is they give you not only real GDP growth, but also the nominal GDP growth. That is the growth in output at current prices. Based on that, the budget, that is the finance ministry, will estimate the next year's GDP. And from that, they will estimate the tax to GDP and hence the tax growth, the fiscal deficit to GDP, and hence how much expenditure they can design. So this number becomes important because on this base, next year's GDP is calculated. So what does our poll say? Our poll says that the real GDP in the current year will be 6.3%, a shade lower than the 6.4 we got when we did the poll end of 2024. But it's still lower than the Reserve Bank's number of 6.6%. So 6.3 is a bit of a disappointment if it comes that way. But the more important number, like I told you, is the nominal GDP number. There, the poll said it will come up at 9.9%, which means the actual GDP in trillions of rupees is going to be 324.5 lakh crore or 324.5 trillion rupees. Contrast this with what the budget assumed. In Feb 1st, 2024, when the budget was presented, it had assumed a 10.5% growth in the nominal GDP to 326.3 lakh crore. So actually, the real number may be a little short, which means 4.9% of that number, 326 lakh crore, was the fiscal deficit, which was about 16.1 lakh crore. Now that the nominal GDP is likely to be smaller, if that's what the MOSPI says, 324.5 lakh crore, then actually even this year's fiscal deficit will have to be lowered to 15.9 lakh crore. And on the basis of that 324.5 lakh crore, next year's GDP will be estimated by the budget on Feb 1st. But let's see what the MOSPI says. It will be very closely watched because after that 5.4% second quarter GDP growth, there was a bit of a shudder in the Indian economy enthusiasts. So we will have to see how much the MOSPI assumes by way of recovery in the second half.
Yeah, Lada, not just the economy enthusiasts, but even in the market circles, while the market has been crying about weak earnings for a while, let's see what the advanced GDP estimates look like, because the CEA, remember, has been maintaining that there is a very high likelihood that maybe even the second quarter GDP shocker, that number, even that could get revised higher as we move towards the final estimates. But anyway, we'll watch out for what the advanced estimates of the full year say today. With that, let's take a quick break, come back with more on the markets in just a bit.
Welcome back. Well, it's going to be at least a 100-point gain today, 23,700. After the kind of sell-off that we saw yesterday, the bulls will take it. At least it's a positive close. At least we're going to end higher. Jay Bal of Cash the Chaos joins us on the show. Hi, Jay. First time we're speaking this year. So happy New Year to you. How are you feeling about the markets? First of all, congratulations. You know, the dollar index, I recall it was 103, 104, and you said it's going to 109. It went there, I think 109.5 or thereabouts. So kudos on that. Give us your fresh call. What's the dollar index going to do? Has it peaked out? Will it cool off from here on? And what about the Nifty? I think you're betting it on it's going to go lower. How much lower can it go?
Thanks, Nigel. Good to be here, and happy New Year to you and all at CNBC-TV18 and all your viewers too. See, the dollar index first, it's pulling back like I'm anticipating. The support's coming about 105.9 and 104.8. But the shallower it is or choppier it is, it's more bullish for the longer term for the dollar index. When it comes to the Nifty, I'm anticipating a break of the November low of 23,264, if I'm not mistaken. It's just a matter of time. The Nifty could meander sideways for a few days or it could break down immediately. But if it does bump up a little more, it's an opportunity to sell. That's my opinion. The main reason is because the banking index is below a trend line from 2022, and it's also clocking a head and shoulders top. So if it breaks below 49,700, the fall is likely to be quite fast. And HDFC Bank, like I've been pointing it out, that's also come to a key support. If it had to break yesterday's low, I think there are more downsides to work with.
By the way, MobiKwik, where the loss narrowed on a quarter-on-quarter basis, the company has reported a loss of 3.6 crore, but it's lower than the loss of 6.4 crore in the prior quarter. We're talking about Q2 FY25. MobiKwik stock is now up close to about 8%, so it's been a big mover. Jay, what about individual stock ideas?
Yeah, I have one long and one short today. The long is on Aegis Logistics. I was hoping the stock would stay down when I'm speaking, but it's actually spiked up in the last 15-20 minutes. I'm anticipating this stock to buck the lower trend and go to somewhere about 1,500. A stop loss at about 749 is required. If the stock were to touch about 1100 ballpark, some partial booking might be ideal. But the stock is looking quite strong, and when the markets were down about 1.5%, this stock was going up 7.5%. So this is a stock that's swimming against the stream. It's a very strong stock on the long side. And I have one short call. It's from the banking space, which I'm anticipating it to underperform over the next few weeks. Short call on Federal Bank with a stop loss of about 207.5 and with a price objective of 182.
Okay. Got that. Just look at, Jai, hi, good afternoon. Just look at BSE as well. BSE is a, we looked at Aegis, and Aegis Logistics is one of Jai's calls. Look at BSE. Okay, it's come off a little bit. But again, started the day at about 51.50 or so, went up all the way to about 54.50, round about there, and then is basically cooled off. So there is some more price action which is coming through. Jay, sorry, in terms of sectors which are looking the most vulnerable, what would be on your list? I mean, just to tie in with the market level earlier.
Yeah, that's right. Banking is one. And actually, the problem is I've been pointing out of Reliance underperformance being a non-starter for the bulls from August. So that's 10% of the market, and the banking index is 1/3 of the market. So, we have more problem coming through for the markets. And the other one is the BSE Capital Goods Index. If you look at it, it's actually broken the trend line from the pandemic low. If you connect the low of 2022, it was supporting the lows of November and December. The markets are now trading below the trend line starting from the pandemic low. So also Larsen & Toubro, which is a key component of the Capital Goods Index, is exactly at the trend line from 2020. So, any close below, 35.50, that will draw additional drag for the Capital Goods Index. So I'm anticipating banks, Capital Goods Index to be the fresh laggards for the markets. So watch out any weakness within the space. Siemens is clocking a triple top, and that's probably the contributor for the banking capital goods being a drag here. So if Larsen were to break below 35.50, more drag on the capital goods sector.
Okay, triple top on Siemens. Pretty ominous there with banks and capital goods. You're saying that both of these, economy-facing segments are flashing red. Then talking about possible safe havens, Jay, how are some of the larger IT names looking? We're anywhere, now running into earnings season, so there'll be plenty of news flow as well. But what are the charts indicating for the big names like Infosys, TCS, etc.?
I've been, asking people to avoid Infosys and TCS for quite some time now. Infosys has defied that and has come to record highs and then come back lower. But TCS is behaving quite well and it's quite weak. And once again, the trend line from 2022, that's been broken for TCS. And any close below 40.30 is a negative, further negative for the stock. But the Nifty IT index as such, that's the only index that's not broken down. The key support is at 41,000. As long as the 41,000 holds, we might look at the stretched mid caps like Coforge and Persistent, but we just be pushing a luck too much. So be very, very light on it. And 41,000 on the Nifty IT index is extremely important. In fact, actually 42,500 some people might consider that as a breakdown from a head and shoulder stop. So 42,500 and 41,000, very important levels for Nifty IT index.
A quick word on Reliance Industries, last year's big underperformer, but today you're seeing good price action, good volumes. Is there more upside?
I would have preferred Reliance to make one more low below 1,200 1200, that would have completed a bottom formation for the stock. But unfortunately, the stock printed 1239 before printing 1201. That says that probably two more sequence of lower lows coming for Reliance Industries. But it's not a short because the risk reward isn't that great. Probably I'm anticipating it to bottom around 1186 to 1040. So so have these two numbers in as projected levels. Once those two levels come through, then we can look at buying Reliance. Probably a sizable rally is due post that.
Okay, all right. Just hold on, Jay. We'll quickly take stock of the market as we're getting into the close. And then we will wind down for this edition of Closing Bell. At the close, it looks like the market will at least go home with gains of about 75 to 80 points in the Nifty. So the bulls will take this with both hands. We're probably ending just around this 23,700 mark. Let's talk about the key movers on the way up then. ONGC with a 4% gain. Some of the life insurance stocks have done really well today. SBI Life and HDFC Life, number 2, number 3 on Nifty. Then there's Tata Motors, Adani Enterprises, you have names like Reliance, Hindalco, all chipping in. So it's really across the board today, the gainers tally. The Bank Nifty has actually outperformed the Nifty, and that's showing up in the way the likes of ICICI Bank have done today. IndusInd Bank, ICICI Bank, big names, all on the positive side. Let's look at some final rates for SBI, 0.25% higher. HDFC Bank is very, very quiet. It's not really participated in the wider banking move today. Very flat on HDFC Bank. On the flip side, there's some nervousness on IT names. TCS, Infosys, the stocks that we were just discussing with Jay, both are down between 0.5% to 1.5%. And some more profit taking in auto today. Eicher, Hero Moto, Maruti, M&M. A lot of the auto stocks have been down between 0.5% to 1.5%. So IT and auto weak, but the rest of the market saw a fair amount of gain today, at least the large caps.
Mid-cap index ends with a gain of about 0.8%, but came off nearly 0.5% from the session highs or from the day's high. So a little bit of profit booking. On the way down, you had big cuts coming through on Zomato and Swiggy, 4% down. PVR Inox is at a 52-week low after having fallen 27% in the last 1 year. Kalyan Jewelers update, post the Q3 update was fine, but the stock corrected close to about 3%. Varun Beverages under pressure. Bajaj Housing Finance fell on pretty large volumes. On the way up, Indo-Farm Equipment, the new kid on the block, 28% up. Aegis Logistics, the stock that Jay was just recommending, that was higher. And Equinox India locked in an upper circuit of about 20% after getting the NCLT approval for its merger with Embassy. Well, it's curtains down. A little bit of a rebound after yesterday's sharp fall. The Nifty ends at 23,700. Broader markets outperform. Don't go anywhere. On the other side of the short break is Markets Forward.